So here was the butterfly team that we put together from last week. We went in and looked at a standard butterfly, just flat out butterfly, kind of boring. If I do a standard butterfly, I'm usually doing it right at the money, maybe using zero DTE options in an index like the S&P 500. Or look at a modified butterfly. This is what we're going to focus on today. We're going to modify the butterfly, so we're going to pay a little bit more up front. You'll notice like even this is actually graphically makes sense in that on a standard butterfly, you pay a normal amount. You can lose that if it's down below, or you can lose it, if it's down below or if it's up above. This is a put butterfly that we talked about. Stock was trading up here, and this is where our middle strike was. Now, if you modify it, you pay a little bit more, but if the market goes up, you can lose that. So you're losing more than you are over here. But if the market goes down, you can actually make money. So this is open-ended if it goes below this put strike on our modified butterfly. And then we also introduced a skip strike butterfly, which I really like. I think of it as a good alternative to actually a credit spread. Now, on this instance, we're showing that it's done for a net debit, but if I'm doing a skip strike butterfly, I'm going to do this for a net credit. So the marketplace, if the market goes up on the skip strike butterfly with puts, you would have a small net credit. And on the way down, you got a lot of risk on the downside. So basically the exact opposite of the modified butterfly. But a lot of people will call this a modified butterfly. I prefer skip strike because you're literally skipping a strike and betting a call spread in it. A put spread in this instance to pay for the butterfly. All right, so I already have a question. What kind of adjustments would you do if a butterfly was put on in very low volatile environments and it keeps being challenged on the upside? I don't think it's going to change. That question was asked by N, and we answered this live, so I'm just going to let that one go away because that's what this is about. You can look at the adjustment, and the adjustment will apply. We're going to do the put side of things because this is where we started with our butterfly team, is on the put side of things. But the adjustment could be applied to calls, so I'd say hang on. So if you just look at a standard butterfly, it's a ratio. You're buying the stock that, if we're doing put butterflies, which this one is considered a long butterfly with puts. If you're doing these, the stock is, if I'm doing puts, I'm being directional. It usually means that I want the market to go down. So the stock is up here somewhere by strike C. You want it to drift lower down to strike B, hang out there, and then be there at the expiration date. So we're going to buy a put at strike C, then sell two puts at strike B and buy a put at strike A. Very low risk, right? It's the net debit that you paid for it, but you need it to stay within the wings of the butterfly. Now, how is this trade made up? If you look at this, if you buy a put at strike B and just sell one put, at strike C, and then sell one put at strike B, what you have is a long put spread. It would go up like this, and then it would extend out. And then on the other side, if you sold that same put at strike B, and then went lower on the scale and bought one at strike A, that would be a short put spread. And it would look like this, and then you would go this way. So I'm going to click on those. So basically what a butterfly is, it's a combination of a long spread and a short spread. This line gets offset by this line, and you come up with a long butterfly. Now, why am I showing you this? I can tell from the questions that at least everybody that's asking the questions has a pretty good feel for what a butterfly is. But the reason why I'm bringing this up is because this is going to be our modification on the butterfly. We're going to roll into and out of spreads by doing this trade. We're going to start with the first modification, which means we're going to start with a butterfly, and then we're going to roll into a spread when the market goes against us. But if you look at these two spreads, right, the long put spread wants the market to go down, and the short put spread wants the market to go up. Now remember, the long put spread wants it to go down, and a short put spread wants it to go up.